Since 2012, shares of Chipotle have returned 10x for investors who've held throughout that period. Now, admittedly, I was not one of them, and restaurants are not often how I like to invest. But earlier this year, I bought shares of the Chipotle of Mediterranean food, Cava group, even though I admitted it doesn't fit my framework and it is quite expensively priced. So, why did I buy shares in the first place? Well, simply because sometimes there are opportunities out there, and if I'm willing to just take a small amount, could really pay off. Well, the company reported earnings after the market closed today, and I don't think it's an exaggeration to say they absolutely knocked the cover off the ball. This was an incredible earnings report from the company. So let's dig in and see what it means for investors. Obviously, as of the time of this recording, I do own shares of Cava Group. Want to give a shout out to finchat.io for sponsoring today's video. This is the craziest calendar I've ever seen. The report is for the second quarter of fiscal 2025 ending July 14th of 2024. You go figure that out. I don't know. After the market opens tomorrow, it'll be in the ballpark of a $12 billion company. So on the top line, revenue grew 35%, which handily beat analyst estimates. Management was calling for a midpoint of comparable store sales. Now, this is really important. That means ignore all the new stores that Cava has built and just compare the stores that were around a year ago to the ones that are still around today. They said for the full year, they expected those sales at those stores to increase 5.5%. But just for this quarter, they were up 14.4%. And this is really important. Of that, 9.5% increase in traffic. So this is clearly resonating with customers, and a 4.9% increase in the ticket items. So any inflationary costs in the food or labor are easily being passed on to the customer. This is incredibly strong. More on that in just a minute. Earnings per share were down to 17 cents. That's actually on a GAAP basis. That's not correct, but it handily beat analyst estimates. For the full year, management was calling for a profit margin on the restaurant level of 24%, but during this quarter, they came in at 26.5%, also a beat. So far, so good. Let's look at margins. Gross margins expanded. Now, that might not seem like a big deal, going from 26.3 to 26.7. It's a huge deal, and I'll show you why. Those operating margins almost doubled, more than doubled, and the same thing with net margins. Those are all on a GAAP basis. Free cash flow went from a loss to a gain, and on a trailing 12-month basis, this company is now free cash flow positive. Big deal. Net income more than doubled. The balance sheet is in fantastic shape. $344 million in cash and investments. Zero long-term debt. Let's look at the dynamics of what's going on here. So, as I said, revenue is up 35%. Now, the cost of the goods sold, which is food, beverages, packaging, labor, occupancy, all these things to run the business, was up 34%. Now, that might not seem like a big difference, but the reason this is coded green is because it grew slower than revenue. And that is a big deal because every little bit of margin that you can eke out of a restaurant business is a huge deal. And that continued when we look at operating expenses like general and administrative, pre-opening costs, and so forth. Those were only up 30%. When again, those rise slower than revenue. This is what happens. Those might seem like small things, but this is what happens. You see income from operations almost triple, and you see net income more than triple. What else happened during the quarter? Well, for this, we're going to go to finchat.io. If you click the first link in the show notes below, you can use the website for free for full functionality. If you use that link in the show notes below, you'll get 15% off an annual subscription. So I head on over to finchat.io. I click on this segments and KPIs right here. The numbers are already filled in, even though the company just dropped these numbers 1 hour ago. Comparable store sales, but first, what we want to look at is restaurant level profit. Restaurant level profit. Now, the reason that this took a dip, even though sales went up so much, is that before there was some revenue coming in that was not associated with Cava. It was an acquisition of Zoe's Kitchen, and that has been discontinued. So what really matters here is the growth rate in the restaurant level profitability It grew 37%. That is very important because, again, that is faster than 35% revenue growth. However, if there's just one thing you're going to look at for the strength of a restaurant, it will almost always be comparable store sales or comps. Again, it was at 11% at the end of last year. It dipped to 2.3%, which was expected. But again, management's guidance was for just 5.5% growth for the full year. And this came in at 14.4. I mean, almost 10% increase in traffic, an almost 5% increase in each ticket, each order that's rung up. That's incredibly powerful right there. And it justifies what is a very expensive stock. And we'll get to that in just a minute. The other thing I just want to show right here is this is the average unit volume, or the amount of sales that each location is doing. And you see that there was about $2.7 million in sales on a quarterly basis right here. That was up 3.5%. And this includes a whole bunch of new stores that opened during the quarter. So finally, let's look at this. The total number of stores sitting at, there's just 341 locations. I live in the Midwest, and there's a grand total of, as far as I know, one. I have to travel all the way to Chicago to get there. So there is still tons of room for growth here. You see that 18 stores were open. The company did go on kind of an opening spree from mid-2022 to mid-2023. They purposely pulled back on that to make sure that they weren't losing quality as they opened up these locations. But man, oh man, there's still a lot of room for growth in this quarter. Now, what else did we know? Now, here's what management said. Now, at the beginning of the year, management was calling for a midpoint of 49 new stores during the year. Last quarter, they upped that to 52. This quarter, they've upped it to about 55 or 56. So going from saying we'll open about 49 stores to now 56 stores, that's a 14% bump in the total number of new stores that are being opened. Not insignificant. This, I would have to say, is the most important one. When the year started, management was calling for a midpoint of 4% comps growth. Remember, that's the most important thing. Gross margins being the second most, by the way. 4% comps growth. And then after the first quarter, they upped it to 5.5%. Now, after they came in at 14.4%, they've upped it all the way to 9%. A huge increase. The restaurant level profit margin at the beginning of the year, they called for it to be 23%. Then they upped it to 24%. Now it is 24.5%. And finally, adjusted EBITDA, which I'm not a huge fan of. Beginning of the year, they were calling for 89 million in adjusted EBITDA. It's all the way up to 111 million. That's a huge increase right there. The bottom line is this company is proving very, very popular with consumers. They are coming in, they are buying more. It is a good story so far. So what about moving forward? Well, the guidance that management gives is what I showed you right there for the full year. Analysts are expecting 26% growth in the current quarter. Don't be surprised to see this revised upward significantly in the coming days. And they're calling for 9 cents per share for the full year. Analysts are expecting 24% top line growth. Again, do not be surprised to see that revised upwards later on in the coming days. So any final thoughts on Cava is just that this company is proving very, very popular with consumers. But what about the stock price? Well, get to that in just a minute. What am I going to watch moving forward? First is comps, but within that, I think keep an eye on traffic and ticket. I love seeing traffic going up so much because it shows that the company is popular with consumers. The ticket going up is important because it shows that they can charge incrementally more or get each guest to buy incrementally more. Number two, gross margins. If you increase comps, but your gross margins goes down, that's not a sign of strength. So the sign that the gross margins are expanding, that's the 1-2 punch you got to have, those first two things. Number three, keep an eye on openings because there's a huge runway for growth there. Number four, free cash flow. They crossed that Rubicon. They're now free cash flow positive. No doubt the moat is widening, although with any restaurant, the moat can be pretty narrow, but the moat is widening and the thesis is on track for owning this. Like I said at the beginning, this is not my typical investment. It scores a 5 on my antifragile score. Why? Because as I said, the moat's pretty narrow because there's not a ton of optionality. It's just open more stores, come up with menu items that resonate with customers. But now let's turn to that valuation. For that, we head back to finchat.io. And so what I'm going to do to look at that is I'm just going to go right here to ratios, and I'm going to look at forward valuations because this is a growth story after all. So I'm going to look at forward PE, forward price to free cash flow ratio. And here's what I see. The company's forward PE ratio is 263. The company's forward price to free cash flow ratio is 1100. So obviously the company looks ridiculously expensive based on that, but I don't think that's the best way to do this. Another way we could do this is by looking at the company's reverse discounted cash flow analysis. So they type in the ticker symbol right here. I think it's fair to give it a higher than a terminal growth rate because we're talking about a company that could 10x the number of its locations. Give it a normal discount rate. And right now, it's got trailing free cash flow of just $11 million. So just crossed the Rubicon, like I said. So how fast does that free cash flow have to grow moving forward with the stock trading at about $108 per share? Well, this is going to be a ridiculously high number, 70%, maybe 60%. No, maybe like 65%, maybe 68%. Somewhere between 60 and 68%. The bottom line is that's ridiculously expensive. No one should invest if they're just planning on free cash flow growth that fast without this caveat. The company is not optimized for free cash flow right now. However, if we look at Chipotle, they got about 12% free cash flow margins when they are able to truly max it out. What if we assumed Cava had that right now? Well, if we assume Cava had that right now, instead of $11 million in free cash flow, they'd have $102 million in free cash flow. Well, now we can pull this down, maybe 30%. Well, it's still higher, 35%, maybe 33%, maybe 32%, about 32%. So what did we solve for? What we said here is that Cava is going to have to grow their revenue now by about 32% per year to justify the stock price over a decade. Even if we make this a terminal growth rate of 4%, that just bumps it down to about 30%. What do analysts think is going to happen with the company's revenue growth moving forward? Well, if we look at this, we can just pull this up, the growth rate, and just say, all right, well, how fast is this expected to grow on an annual basis? And I can just read this off if you can't see it. They're basically saying 20%. So the bottom line is that no matter what way you cut this, Cava is still ridiculously expensive. In order to justify this stock price, it needs to continually impress with their comps and their gross margins moving forward. It's the only way to justify this stock price. However, if they're able to grow the number of locations they have while growing the comps, while expanding those gross margins, well, then I could see it. This is why I own shares of the stock, but it's also why it's a very small part of my overall portfolio. Now, knowing when to break the rules and when not to, especially based on a company that scores so poorly on my own framework, that's tough to know. And I'm going to be teaching an absolutely free webinar on the most important thing in investing, which is moats. Moats. A free investing masterclass webinar on August 29th at noon Eastern time. If you can't make it, register for it and you will still get a link with the recording. It is the second link in the show notes below where you will learn about the 5 moats every investor must know, how to spot them, and just give examples of each one. So I hope you join for that by again clicking the second link in the show notes below. Look, as a Cava shareholder, I'm extremely happy with this, but there is no way that I'm going to add shares at this valuation. If this company truly fulfills its potential and has the returns like Chipotle does, I'll be happy owning between 1% and 2% today. And if it doesn't, I'll be glad that I only did own between 1% and 2% today. But let me know what you think of Cava's earnings in the comment section below. And don't forget to subscribe so you can keep up with updates on this company when they report in 90 days. Until then, Brian, out.